Hi, I'm Corey Litzenberger from CGLTax.ca, and this is Brainstorming Plus Tax. On this episode of Brainstorming Plus Tax, we are going to take a look at some tax planning that can be done for our friends that are seniors and retired. Now, income tax is a big-ticket item for most retired Canadians. Especially for those who are no longer paying a mortgage, the annual tax bill may be the single biggest expenditure that they are required to make each year. Fortunately, the Canadian tax system provides a number of tax deductions and credits available only to those over the age of 65, like the age credit, or only to those receiving the kinds of income usually received by retirees, like the pension income credit, in order to help minimize that tax burden. And in most cases, the availability of those credits is flagged either on the income tax form, which must be completed each spring, or on the accompanying income tax guide. There is, however, another income tax saving strategy which is not nearly as well known. Even more unfortunate is the fact that the benefits of that strategy, and the ease with which it can be accomplished, aren't readily apparent from either the tax return form or the annual income tax guide. Now, that tax-saving strategy is pension income splitting, and it's likely the case that many taxpayers who could benefit aren't familiar with the strategy, especially if they are not receiving professional tax planning or tax return preparation advice. That's a particularly unfortunate reality because pension income splitting has the potential to generate more tax savings among taxpayers over the age of 65, and certainly those over the age of 71 for whom RSP contributions are no longer possible, than just about any other tax planning strategy available to retirees. In addition, it's one of the very few tax planning strategies which requires no expenditure of funds on the part of the taxpayer, and which can be implemented after the end of the tax year, at the time the return for that year is filed. When described in those terms, pension income splitting can sound one of those too-good-to-be-true tax scams. But that's not the case. Essentially, what pension income splitting offers is a government-sanctioned opportunity for Canadian residents who are married, and usually where recipient spouse is age 65 or older, to make a notional reallocation of private pension income between them on their annual tax returns and to benefit from a lower overall family tax bill as a result. Pension income splitting, like all forms of income splitting, works because Canada has what's called a progressive tax system in which the applicable tax rate goes up as income rises. The general rule with respect to pension income splitting is that a taxpayer who receives private pension income during the year is entitled to allocate up to half of that income without any dollar limit to his or her spouse for tax purposes. In this context, private pension income means a pension received from a former employer, and where the income recipient is age 65 or older, payments from an annuity, a registered retirement savings plan, or registered retirement income fund. Government-sourced pensions like the Canada Pension Plan or Old Age Security do not qualify for pension income splitting, regardless of the age of the recipient. The mechanics of pension income splitting are relatively simple. There is no need to transfer funds between spouses or to make any change in the actual payment or receipt of qualifying pension amounts, and no need to notify a pension administrator. Taxpayers who wish to split eligible pension income received by either of them must file Form T1032, the joint election to split pension income, with their annual tax return. Now, that form, which is not included in the annual tax return package, can be found on the CRA's website at www.cra-arc.gc.ca. Just search for T1032. That's Form T1032. You can also order it by calling the General Inquiries line at 1-800-959-8281. Now, on this T1032, the taxpayer receiving the private pension income and the spouse with whom that income is to be split must make a joint election to be filed with their respective tax returns for the year. Since the splitting of pension income affects the income and therefore the tax liability of both spouses, the election must be made and the form filed by both spouses. An election filed by only one spouse without the other will not suffice. In addition to filing the T1032, the spouse who is the actual recipient of the pension income to be split must deduct from income the pension income amount allocated to his or her spouse. And conversely, the spouse to whom the pension income amount is being allocated is required to add that amount to his or her income on the return. Essentially, to benefit from pension income splitting, all that's needed is for each spouse to file a single form with the CRA and make a single entry on his or her current tax year return. By the end of February or early March, taxpayers will have received or downloaded the information slips which summarize income received from various sources during the past year. At that time, couples who might benefit from this strategy can review those information slips and calculate the extent to which they can make a dent in their overall tax bill for the year through a little judicious income splitting. To find out more about this pension income splitting potential, perhaps you should be contacting your local chartered professional accountant for more information. And with that, for CGL Strategic Business and Tax Advisors, I'm Corey Litzenberger. Thanks for listening.